Welcome back, and we're joined by Basudeb Banerjee, Senior Research Analyst at CLSA India. Basudeb, thank you so much for waiting by very patiently. It's corporate earnings season time, and things can be very tricky when it comes to live TV. But let me come to you straight off with regard to the Q1 numbers. They've been very robust, right? The GST rate cuts that have happened still translating to good demand on ground. Do you believe that's the only or one of the only components which is driving the kind of numbers that we're seeing?
Yeah, hi, morning. Thanks for inviting me. So one needs to differentiate between two aspects. One is it's not only about growth. One needs to look about profitable growth. So one section of the industry which has been growing in excess of 20%, with hardly being able to take a 1% price hike. And another section of the industry which is growing at an equivalent pace but have taken much superior price hikes. So the quantum of margin damage along with this kind of volume growth, that one also needs to focus on rather than just looking at the volume growth aspect.
Basudeb, hi, morning. Sajid here. Do you see some bit of moderation in growth coming in because of the base effect starting from August, September?
So see, that is very much known and nothing surprising. So the kind of 25% growth which PVs or two-wheelers are witnessing today, that is a combination of, obviously, as you highlighted, the GST cut, plus the very subdued market sentiment, which resulted in weak base in first half of CY25. So anyways, most of we believe that the prices are not at all building in proration of these kind of 20% plus growth. So stock prices are more or less pricing in a logical kind of industry growth situation. So I don't see that the transition from 25% growth to a single digit growth would be detrimental from a outlook perspective or consensus earnings perspective.
And where do you see a pressure coming in? Do you see some margin pressure coming in now? Because beyond a point, many of the companies may not be able to transfer the cost escalation or raw material price escalation to the consumers because it may start impacting the volumes for them. Do you see that kind of pressure getting absorbed by some of the companies?
So if you actually see the we came out with analysis of the quantum of price hikes required, with steel prices being higher 20%, aluminum prices also being higher 25 odd percentage, Brent crude, natural rubber prices, as you know, the way they have moved, which meant somewhere around 6-7% price hikes at ex-factory level in general. And a few spaces like commercial vehicles or say a few utility vehicle makers have already taken 4 to 5% price hikes. And if you look at since June, Brent has corrected from 110 levels, aluminium has corrected almost 15-20%, which means no more it is required to take a 6-7% price hike. So somebody who has taken a 4-5% price hike is good enough to sail ahead in terms of business and take benefit from the festive season ahead. So I don't believe that further incremental margin pressure would be there with players with good pricing power or who are beneficiary of a weaker local currency.
Basudeb, just with regard to price hikes, you believe that a lot of the commodity price inflation will get offset with the kind of price hikes that most have taken already? And is there scope for more price hikes? And the impact of that on demand, you reckon, what would that be?
I will say that across the two-wheeler space, the discipline of price hikes have been quite robust. Across the commercial vehicle space, the quantum of price hikes have been quite robust. It is the mass market passenger vehicle space where despite volume growth of 20-30%, the quantum of price hikes have been quite subdued. Barring that, in all other spaces, even in tractors, price hikes have been quite strong. So from a margin outlook perspective, I believe it's high time that mass market car segment, one should not be surprised